Hi, it's Sean Ferrugia from Optimised Accounting, and today we're recording a short 2020 federal budget wrap-up, and particularly how it relates to small and medium-sized businesses. As you're probably aware, these budget wrap-ups are usually done in May, but due to COVID-19, the Treasurer decided to delay the federal budget until last night, which was the 6th of October. So last year's federal budget was all about being back in the black and paying off the government debt. Due to COVID, that's sort of now out of the realm of immediate possibility. And the statistics are that we are definitely back in the red by about $213.7 billion in the next financial year, which is about 11% of GDP. Net debt this year is expected to be $703 billion. By comparison, it was $85.3 billion last year. And the deficits are likely to be in place until June 2024, which will give us a net debt of around $966 billion at that stage. The Treasurer did say that the aim of this year's budget is to bring the economy out of hibernation, and he's going to do this by encouraging spending and employment. So the first measure that was announced was the bringing forward of the previously legislated tax cuts. So what's happened with these cuts? These were originally due to come in on the 1st of July 2022. These have been brought forward and backdated to the 1st of July 2020. What's happened here is the increase in the 19% bracket has the upper threshold of the 19% bracket has gone up from 37,000 to 45,000, and the upper threshold of the 32.5% bracket has gone up from 90,000 to 120,000. So what this means is that somebody earning between $45,000 and $90,000 will save about $1,080 in tax this financial year. Someone earning $90,000 plus will save up to between $1,080 and $2,430, with income earners earning above $120,000 getting that full $2,430 tax cut. Now, low-income tax offset has increased to $700. This applies to income earners earning below $37,500. This is up from $445. And importantly to note is that the low to middle income tax offset that has been applicable to individuals when they lodge their tax returns, this is for individuals primarily earning between the $45,000 and $90,000 bracket. The $1,080 that you've got as part of your tax refund, that will also still apply this year, even though they have brought forward the tax cuts. Now, originally, when the tax cuts were originally supposed to start in 2022, the low to middle income tax offset was going to be abolished. So at least for this year, there's basically a double dip involved and you can get the benefit twice. Whether or not that'll continue in the 21-22 year is remaining to be seen. Now, because the Treasurer is trying to stimulate spending, what's going to happen is withholding rates are going to be changed once these tax cuts do get through Parliament. So what this means is that probably from, say, November until the end of June, so 8 months of the rest of the financial year, your employer or employers will take out less tax for that period of time to give employees more money in their pocket to spend throughout the year. Now, from July onwards, the tax cuts will still remain the same, but they'll be smoothed out over a 12-month period. So what it means is from November, employees will get a little bit more money in their pocket through the payroll system. From July, they'll get a little bit less than that increased amount, and that's purely because the tax cuts is being smoothed over the 12 months rather than the 8. The next thing that was mentioned was the job maker hiring credit. So what this is a credit of up to $200 per week for hiring of an additional eligible employee. So this starts from today, the 7th of October, and runs for 12 months. The maximum rebate is $200 per week for a new employee aged between 16 and 29 years of age, and $100 per week for a new employee aged between 30 and 35 years of age. This is targeted at the younger end of the workforce. It was mentioned that the unemployment statistics, well, they're not good at the moment. Young people in these age brackets are overrepresented. So the aim is here to get people between 16 and 35 years into the workforce. Now, to get these rebates, basically what it means is that an employer will be eligible for up to $10,400 per new employee that they take on between 16 and 29, and a maximum of $5,200 for a new employee that's aged 30 to 35. The rule is that an eligible employee must work at least 20 hours per week on average over a quarter, and the employee must have received job seeker, youth allowance, or the parenting payment for at least 1 month in the prior 3 months before they were hired. So this is really aimed at getting people off of the social security system, so any of the Centrelink payments, and back into the actual workforce. Now, the actual mechanics of this is that this will be paid quarterly in arrears to the employer. So for the October to December period, it'll be paid from the 1st of Feb. We assume that this will be part of a BAS process, or potentially another form. Once everything's all released, we'll no doubt be in contact, and we'll be publishing it on our website. Employees that are also receiving JobKeeper or the apprenticeship incentive are not eligible for this, so they can't be receiving 2 payments at the same time. It's worth noting with this is that any new employee, unless they're self-employed or have another job, they won't be receiving JobKeeper because they just won't have any eligibility for it. They'll fail the basic tests there. So that's probably not as big of an issue, but if the person you were employing was a young person and an apprentice, that's something you definitely do need to keep track of. And also, as an integrity measure, the federal government has said that the job must be an additional job. So payroll and headcounts of the business do need to increase. The exact rules and thresholds of this are not released yet as far as I'm aware, but once again, we'll definitely be updating our website with these details. The next thing that was announced was basically an increase to the immediate asset write-off. So throughout COVID, the immediate asset write-off was increased to $150,000 and was targeted at larger businesses as well. With the new write-off, basically the limit on an asset of $150,000 has been abolished, and it's now unlimited. If the business turns over more than $50 million a year, the asset does need to be new. But if they are turning over less than $50 million per year, then the asset can be secondhand. The asset needs to be installed by the 30th of June 2022. Now, this is basically aimed to increase spending. It's worth noting with this, buildings can't be written off. They're under the capital works system rather than the capital allowance depreciation system, and luxury car limits and things like that will still apply. So the assets that you could claim really do need to be sort of the plant and equipment type of assets. Now, it is also worth noting that this is not a cash rebate. It's basically a tax deduction. All this is doing is bringing forward tax deductions into the current year rather than having them teased out over a longer period. Small businesses with less than a $10 million a year turnover can deduct their small business pool balance in full at the end of each financial year up to the year 30th of June 2022. What this means is that any assets that are on any depreciable assets rather that are on a company's balance sheet or a business's balance sheet up to that year can be written off each year to bring forward the depreciation. The next thing was announced was the bring back of the loss carryback measure. I think this was last in with Julia Gillard around the 2013-2014 years, and it made a brief appearance and then disappeared. So what's going to happen this time is that rather than carrying forward a loss that may be made in a business to be offset against future income, it's going to now be possible to offset losses that have been made in the 2020 financial year, so the last financial year, the 2021 financial year, the year we're in at the moment, or the 2022 financial year, which is the year that starts in July next year. If a business makes a loss in any of those years, they'll be able to offset that against profits and therefore tax paid in the 2019 or later financial year. So what the aim is here is that if a company has made a profit in 2019 financial year or later and then subsequently made a loss, bleed due to COVID or the economic problems, then any of the tax that they paid on that profit could be refundable. Now, this will start in the 2021 and the 2022 company tax returns, and it is also worth noting that you can't create a franking deficit by doing the carryback measure. So a franking deficit, generally this will happen is if a company's made the profit, paid out a dividend to its shareholders with a franking credit, so its own share of the tax. If those distributions of dividends have included tax credits, the franking credits, the limit of the amount of tax you'll be able to get refunded will need to be adjusted to take into account the franking balance. The next thing that was announced was some FBT measures. So they were looking at implementing the simplifying of FBT record keeping. So all these measures are due to start from 1st of April 2021, so the new FBT year. With the record keeping, it's aimed at not having employers keep additional records for FBT purposes. So rather than having employee declarations, other records that the company may have to hold for other compliance reasons should be enough for FBT purposes as well. Exactly what this means is left to be seen, but no doubt we'll hear about it before the start of the new FBT year. There's also going to be an FBT exemption on retraining and reskilling of employees. So this happens if you were to offer a redundancy or basically a package to an outgoing employee. Sometimes this will include an allowance to retrain or reskill the employee. Traditionally, an employer has to pay fringe benefits tax on this. These will now be FBT exempt. The cap on having one portable electronic device per year is also being abolished, which means that employees will be able to salary sacrifice or be given from their employer up at more than one portable electronic device in a year and not have to be subject to FBT. So this means it could be an iPhone and an iPad rather than just an iPhone. Also, FBT on car parking in non-commercial car parks is also being taken away. So this is more for businesses that have got underground car parks and they're providing those for free to their staff. That benefit will no longer attract tax. Now, superannuation. So there's a couple of changes here. The first one is that employers will now need to pay super for new employees into an existing fund that they have rather than just setting up a default fund. So the way that this will work is that employers are going to have access to an ATO portal, which will allow them to look up their new employees' existing super fund details. So by default, an employer will be able to pay into an account that is already existing on the employee's behalf. The idea behind this is so the employee doesn't have multiple small super fund accounts that are being eroded by fees and maybe pointless insurances. Now, if it's an employee with a first job or doesn't have another super fund account, then of course the employer will be able to use their default fund and set up an account on their behalf. But the first point of call will be to check that ATO system and pay into an account that they already have. The other interesting one that was announced is APRA, so the prudential regulator that basically manage super funds, the government agency that regulates super funds, are going to start benchmarking funds on a new system called MySuper. So what's going to happen here is that funds are going to have to report to APRA within 3 months of the end of the financial year and advise of what their performance was. Now, any underperforming fund has up to 3 months to notify members that they are underperforming and also to provide them with details of the MySuper comparison tool. Now, if the underperformance is basically going to last for more than 1 year and it's say 2 years of consistent underperformance, at that point APRA actually will have the right to prevent that super fund from taking on new members and new money. So this is going to be definitely an interesting change and likely to cause a bit of an uproar in the super industry, and probably cause more people to sort of go into self-managed super funds and things as well. I'm definitely interested to see where this one leads. The other measures that were announced, so there's a couple of just final measures, is that similar to the $750 payments that were paid out to Centrelink recipients earlier in the year, I think there was a lot of two of those, there's going to be another two lots of $250 paid out to Social Security recipients. This will be paid in November and then again in March. These amounts will be tax-free. 10,000 additional places in the first home loan deposit scheme have also been announced. So this is a scheme that allows first home buyers to have as little as a 5% deposit and still pay no mortgage insurance on their loan. So this will get a lot of younger people into the housing market. The recent change of the backflip, I guess, on the responsible lending changes will also help with getting first home buyers eligible for home loans as well. Also, the third wave of the Victorian Business Support Fund, so this is the one that's currently on at the moment, is going to be tax-free. So this is a measure that Dan Andrews had lobbied the federal government for, and successfully, I guess, got the third wave of the grant to be income tax-free. Now, this will mean as well that if any other states have a similar COVID situation to Victoria and the state governments pay out similar grants, these will also be tax-free, but at the moment it's just the third wave of the Victorian one. And also 100,000 new supported apprenticeship spots have been announced. So from COVID back in March, one of the measures was that a 50% wage subsidy could be paid for eligible apprentices. 100,000 new spots have been announced under this measure. They start from today and it will go for 12 months. If you're wanting this one, you do need to talk to your apprenticeship provider, and it does need to be an eligible apprenticeship, but this will help get more people back into work as well. Now, this is all we have for today. For more of a detailed wrap-up or a written version of what we've gone through, please visit our website, opt.ac/budget 2020. If there are other questions, be sure to let us know, and we'll do our best to answer them. Have a great day. Thanks.